Right now, 9 out of 10 Bitcoin traders are making the exact same mistake, and it could cost billions. Here's what almost nobody sees happening in the market today. On the night of February 5th, 2026, at exactly 7:20 p.m. Eastern Time, Bitcoin crashed through the $61,000 level for the first time since September 2024. Within 4 hours, $817 million in positions were wiped out. Within 24 hours, that number exploded to $2.6 billion. Over 570,000 traders had their accounts completely blown out in a single day. But here's what makes this moment different from every other Bitcoin crash you've seen. The very next day, February 6th, Bitcoin didn't stay down. It surged back above $70,000, gaining more than 11% in a matter of hours. And right there, in that violent snapback, another wave of traders got trapped. If you're watching this video right now, there's a very high probability you're either caught in this trap or you're about to walk right into it. And before we go any further, do me a favor. Hit that subscribe button and turn on notifications for the wealth continuum. Because what I am about to show you isn't being talked about anywhere else in the financial media. They're too busy reading yesterday's headlines, while the real story is unfolding right now beneath the surface. Also, drop a comment below and tell me where you're watching this from. Because what's happening in Bitcoin right now is a global phenomenon, and I want to know where our community is tuning in. Let's start with what actually happened between February 1st and February 9th, 2026. This wasn't just another routine pullback. This was a systematic destruction of leverage positions on both sides of the market. Think about this for a second. Bitcoin peaked at $126,000 in early October 2025. Just 4 months ago, the narrative was unstoppable. Institutional adoption, strategic reserves, Bitcoin as digital gold. Then came January 30th, 2026. President Trump nominated Kevin Warsh to replace Jerome Powell as Federal Reserve Chairman. Within 72 hours, Bitcoin dropped 17%. Gold plunged 20%. Silver crashed a staggering 40%. $250 billion evaporated from crypto markets almost overnight. But most traders completely missed why this happened. They saw the price action, they saw the liquidations, but they didn't understand the mechanism behind it. Kevin Warsh isn't just another Fed chair. He's a monetary hawk with a very specific philosophy. During his tenure as a Fed governor from 2006 to 2011, he was known for one thing above all else: monetary discipline. Higher real interest rates, a smaller Federal Reserve balance sheet, tighter liquidity conditions, everything that's essentially poison for risk assets like Bitcoin. And here's where the trap starts to form. See, Warsh has also said some interesting things about Bitcoin over the years. Back in 2021, when Bitcoin was trading around $30,000, Warsh said, if you're under 40, Bitcoin is your new gold. He's called Bitcoin a policeman that can tell the world when things need to be fixed. He doesn't get nervous about Bitcoin. He's even invested in crypto companies like Bitwise. So when his nomination was announced, some traders thought, wait a minute, this guy gets it. He's pro-Bitcoin. Maybe this is actually bullish long-term. And that's exactly how you build a trap. You give the market just enough hope to keep people engaged while the underlying fundamentals are screaming danger. Because while Warsh might appreciate Bitcoin as a concept, his entire policy framework is designed to create an environment where speculative assets get crushed. Reduced liquidity, balance sheet runoff, slower rate cuts. These aren't theoretical concerns. These are the exact conditions that preceded every major Bitcoin bear market in history. Now let's talk about what happened on February 5th and 6th, because this is where 90% of traders are making their critical mistake. On Thursday evening, February 5th, Bitcoin broke through every major support level like they didn't even exist. The $80,000 level that everyone thought was rock solid? Gone. The $75,000 psychological barrier? Shattered. The $70,000 line that analysts called the key reference point? Obliterated. And then Bitcoin touched 60,062. For about 20 minutes, Bitcoin was trading at levels not seen since September 2024, and the panic was absolutely real. The Fear and Greed Index, which measures market sentiment, crashed to 11. That's the lowest reading of the entire year. Extreme fear doesn't even begin to describe it. This was capitulation. This was forced liquidations, creating a cascading waterfall effect. When Bitcoin hit certain price levels, exchanges automatically sold traders' positions to cover their debts. That selling pushed prices lower, which triggered more liquidations, which pushed prices even lower. It's a domino effect, and once it starts, it's almost impossible to stop. Over $2.1 billion in long positions were liquidated. These were the bulls, the people who believed Bitcoin was going higher. They borrowed money to amplify their bets, and when the market moved against them, they got wiped out instantly. But here's the part that almost nobody is talking about. Over $468 million in short positions also got liquidated. These were the bears, the people betting that Bitcoin would keep falling. And when Bitcoin violently bounced from $60,000 back to $70,000 in less than 24 hours, they got squeezed just as hard as the bulls did. This is the trap. Traders on both sides got destroyed. The longs got liquidated on the way down, the shorts got liquidated on the way up. And now, as Bitcoin sits around $70,000 to $71,000, most traders are frozen. They don't know whether to buy, sell, or just sit on their hands. And here's why this matters so much right now on February 9th, 2026. That $70,000 level isn't just a number on a chart, it's a psychological battlefield. James Butterfill, the head of research at CoinShares, said it perfectly. $70,000 is shaping up as a key psychological level. If we fail to hold it, a move toward the $60,000 to $65,000 range becomes quite likely. Think about what that means. If Bitcoin breaks below $70,000 and stays there, we're not talking about a small dip. We're talking about potentially another 10% to 15% drop, which would take us right back into the liquidation zone. And once that starts, there's no telling where the bottom is. Now, I'm not saying that's going to happen. I'm not making predictions here. What I'm showing you is the range of possibilities that serious market analysts are now considering. And here's the critical point. Most retail traders, most regular people who own Bitcoin are not prepared for that scenario. They bought Bitcoin at $80,000, $90,000, $100,000, maybe even higher, because they believed the narrative, Bitcoin to $200,000, Bitcoin is a strategic reserve. Bitcoin is the future of money. And now they're sitting on significant losses, and they're making decisions based on emotion rather than analysis. Some of them are panic selling at the worst possible time. Some of them are doubling down, trying to average down their entry price, which could work if Bitcoin recovers or could devastate them if it doesn't. And some of them are doing nothing at all, just hoping and praying that the market turns around. But let me tell you what the smart money is doing right now. According to CryptoQuant, U.S. exchange-traded funds were net buyers of 46,000 Bitcoin this time last year. In 2026, they flipped to being net sellers. Institutional demand has reversed materially. These are the big players, the funds, the asset managers, the people with billions of dollars and teams of analysts, and they're selling. Meanwhile, there are reports of large whales, the mega holders, quietly accumulating at these lower prices. So you've got this interesting dynamic where institutions are selling, retail traders are panicking, and a small group of very large holders are scooping up Bitcoin at what they believe are discounted prices. The question is, who's right? Are the institutions getting out before a bigger crash? Or are the whales positioning themselves for the next major rally? And this is where we need to talk about the broader macro picture, because Bitcoin doesn't trade in a vacuum. It trades as part of the global risk asset complex. And right now that complex is under serious pressure. Tech stocks are selling off. The State Street Technology Select Sector ETF dropped nearly 2% on February 5th alone, marking its third straight losing day. Gold, which is supposed to be a safe haven, has been under pressure. Silver has been absolutely crushed. And oil volatility tied to U.S. drilling. Iran tensions is creating uncertainty across all markets. This is what risk-off looks like. When geopolitical tensions rise, when central banks signal tighter policy, when economic uncertainty increases, investors don't rush into Bitcoin. They rush into the U.S. dollar. They rush into treasury bonds. They pull back from anything that's considered speculative or high risk. And whether we like it or not, Bitcoin is still viewed by most institutional investors as a high-risk, high-beta asset. There's another factor that almost nobody is discussing, and it's potentially massive. There are reports that the selling pressure in early February wasn't coming from the usual crypto traders. Pantera Capital's general partner Franklin B. suggested that the seller might have been a large Asian participant with very few crypto-native counterparties. In other words, this could have been forced selling related to something completely outside the crypto market. Perhaps unwinding of Japanese yen carry trades. Perhaps deleveraging by a major financial institution. We don't know for sure. But what we do know is that when you get massive selling volume from an unexpected source, it can create dislocations in the market that don't reflect the underlying fundamentals of Bitcoin itself, and that can create both danger and opportunity, depending on how you approach it. Let's talk about what happened on Saturday, February 1st, because this was when the first major cracks appeared. Bitcoin fell below $78,000, its lowest level since April 2025. Liquidations on Saturday alone totaled $2,056 billion, making it the 10th biggest single-day liquidation event on record, according to CoinGlass data. Nearly 200,000 traders had their accounts blown out in a single day. And here's the part that terrified everyone. Bitcoin briefly fell below Michael Saylor's average entry price. Saylor, the CEO of Strategy, formerly known as MicroStrategy, has become the poster child for corporate Bitcoin adoption. His company holds over $40 billion worth of Bitcoin. And this brings us to the current moment, February 9th, 2026. Bitcoin is trading around $70,955. It's up about 1.8% from yesterday. It bounced hard from the $60,000 lows, but it's still down roughly 44% from its October 2025 peak. And here's the uncomfortable truth that most people don't want to hear. We have no idea whether this is the bottom or just another bounce in a longer bear market. The technical indicators are mixed. The monthly MACD, which is a momentum indicator that many traders watch, crossed down in November 2025. Historically, that's been a signal that precedes extended downturns. The 200-week moving average, which has acted as a bottom signal in every previous Bitcoin cycle, is currently sitting at around $57,926. That suggests there could be more downside before we find a real floor. But at the same time, the fear and greed index hitting 11 is a contrarian indicator. Extreme fear often marks major bottoms. When everyone is panicking, when everyone is convinced the world is ending, that's often when the smart money starts buying. So what's the trap? The trap is believing you know what happens next. The trap is being absolutely certain that Bitcoin is going to $200,000. Let me tell you what concerns me most about the current market structure. It's the complete reversal in ETF flows. When the Bitcoin spot ETFs launched, they were supposed to represent the institutionalization of Bitcoin. Steady, long-term buying from pension funds, endowments, and sophisticated investors. But in 2026, those ETFs have turned into net sellers. That's not retail investors panic selling on Coinbase. That's institutional money exiting positions. And institutional money doesn't usually exit at market tops. They exit when they see something in the macro environment that makes them want to reduce risk. What do they see that the average retail trader doesn't? Maybe they see the Warsh nomination as genuinely problematic for risk assets. Maybe they see deteriorating economic conditions that haven't fully shown up in the data yet. Maybe they're rebalancing portfolios and Bitcoin just happens to be one of the assets they're trimming. We don't know. But the fact that it's happening should make everyone pause and think. Now let's talk about what could break Bitcoin out of this range, either to the upside or the downside. On the bullish side, you'd want to see a few things. First, Bitcoin needs to decisively reclaim and hold the $80,000 level. Not just touch it and fall back, but establish it as a new support level with sustained buying pressure. Second, you'd want to see ETF flows reverse. If institutional buyers come back in, that provides a fundamental bid under the market. Third, you'd want to see some clarity from the Federal Reserve about the path of interest rates. If Warsh, assuming he's confirmed, signals that rate cuts are coming in the second half of 2026, that could provide the liquidity backdrop that risk assets need. And fourth, you'd want to see some resolution to the geopolitical tensions that are creating uncertainty across all markets. US-Iran tensions, global trade concerns, these things matter for risk appetite. On the bearish side, the catalysts are equally clear. A decisive break below $70,000 would likely trigger another wave of liquidations and send Bitcoin toward the $60,000 to $65,000 range. A break below $60,000 opens up the possibility of a move toward the $50,000 level. And if $50,000 breaks, here's what I think most traders are missing. This isn't 2020 or 2021 anymore. Back then, Bitcoin was riding a wave of unprecedented monetary stimulus. The Federal Reserve was printing trillions of dollars. Interest rates were at zero. Everyone was looking for somewhere to put their money, and Bitcoin was one of the beneficiaries. But we're in a completely different regime now. The Fed is either holding rates steady or potentially cutting them very slowly. Quantitative easing has been replaced by quantitative tightening. The balance sheet is shrinking, not growing. Liquidity is being drained from the system, not added. And in that environment, speculative assets face headwinds. It doesn't mean Bitcoin can't go up. It absolutely can. But it means the path of least resistance has changed. You're swimming against the current now, not with it. And there's one more piece of this puzzle that I think is critical. The composition of Bitcoin holders has changed dramatically. In the early days, Bitcoin was held primarily by true believers, people who understood the technology, who believed in the vision of decentralized money, who were willing to hold through massive volatility because they had conviction in the long-term thesis. Today, a huge portion of Bitcoin is held by traders, by speculators, by people who bought it because the price was going up and they didn't want to miss out. These are not strong hands, these are weak hands. And when weak hands panic, they sell. And when they sell, prices drop. When prices drop, more weak hands panic. It's a feedback loop. The question is whether there are enough strong hands, enough long-term holders, enough buyers who view current prices as attractive to absorb that selling pressure and put a floor under the market. Let me give you some context on just how violent this recent move has been. Bitcoin is down about 23% in the week leading up to February 9th. It's down roughly 44% from its peak in October. The last time Bitcoin experienced this kind of drawdown was in 2022. during the so-called crypto winter that followed the collapse of Terra Luna and the bankruptcy of FTX. The bear market eventually saw Bitcoin fall about 80% from its peak. We're not there yet. We're not even close to that level of decline. But the psychological impact on traders is real. People who bought Bitcoin at $100,000 are sitting on 30% losses. People who bought at $120,000 are down more than 40%. And when you're down that much, it becomes very difficult to think clearly. You either panic and sell at the bottom, or you stubbornly hold on and potentially ride it even lower, or you try to average down and potentially throw good money after bad. There's no easy answer. The options market is telling us something interesting right now. On Deribit, which is one of the largest crypto derivatives exchanges, short-term Bitcoin puts are trading at a premium of over 10 points to calls. In plain English, that means traders are paying a lot more for the right to sell Bitcoin at a certain price than they are for the right to buy it. That's a sign of fear. That's a sign that people are looking for downside protection. And when everyone is looking for downside protection at the same time, it usually means one of two things. Either a major crash is coming and the market is correctly pricing it in, or everyone is too bearish and we're near a bottom. The tricky part is knowing which scenario we're in. Here's something else that should concern anyone holding Bitcoin right now. The correlation with traditional risk assets has increased. Bitcoin used to be marketed as a hedge, as digital gold, as something that would protect you when stocks fell. But look at what happened in early February 2026. Tech stocks sold off, and Bitcoin sold off even harder. Gold came under pressure, and Bitcoin came under pressure. This isn't acting like a safe haven. This is acting like the highest beta, most speculative asset in your portfolio. And if we're entering a period of sustained risk-off sentiment, if investors are de-risking across the board, Bitcoin is likely to be one of the first things they sell, not one of the last. That's not what the Bitcoin maximalists want to hear. That's not what the long-term holders want to believe. But it's what the price action is telling us right now. Let's talk about what happens next with Kevin Warsh, because this is going to be a major driver of market sentiment over the coming months. Warsh is nominated, but he's not confirmed yet. He has to go through Senate hearings. There are reports that Senator Tom Tillis might block the confirmation until an investigation into the Fed building renovation issue is completed. Jerome Powell's term doesn't expire until May 15th, 2026. So Powell is still the chair for now. But the market is already pricing in the possibility of a Warsh-led Fed, and that's creating uncertainty. If Warsh is confirmed and comes in as hawkish as his reputation suggests, if he really does push for a smaller balance sheet, higher real rates, and tighter monetary policy, that's going to be challenging for all risk assets, including Bitcoin. On the other hand, if Warsh turns out to be more dovish than expected, if he signals that rate cuts are coming, if he's more accommodative than his reputation suggests, that could be a positive catalyst. The challenge is that nobody knows. We're trading on perception and speculation right now, and that creates volatility. And volatility creates opportunity for some people and destroys capital for others. The difference between those two outcomes usually comes down to one thing. Are you managing your risk appropriately? Are you using position sizes that allow you to survive the volatility? Are you thinking in terms of scenarios and probabilities rather than certainties? Or are you all in, leveraged, hoping and praying that your bet works out? Because if you're in that second category, if you're over-leveraged, if you put money into Bitcoin that you can't afford to lose, if you're making decisions based on emotion rather than analysis, you're the trader who's trapped. You're the 90% that this video is about. Here's a scenario that I think is underappreciated. What if we're entering a prolonged period of range-bound trading? What if Bitcoin just chops between $60,000 and $80,000 for the next 6 months, grinding both bulls and bears, shaking out weak hands on both sides until we get more clarity on the macro environment? That's not the exciting scenario. That's not Bitcoin to $200,000 by summer. That's not Bitcoin to $25,000 by spring. That's just boring, frustrating sideways action. But that might actually be the highest probability outcome right now. And if that's what happens, the traders who survive are going to be the ones who aren't trying to hit home runs. They're going to be the ones who are patient, who are managing their risk, who are not getting shaken out by every 10% swing in either direction. There's one more thing I want to talk about before we wrap up, and it's the elephant in the room that nobody wants to discuss. What if Bitcoin never goes back to $126,000? What if that October 2025 peak was the top of this cycle, and we're now in the early stages of a bear market that could last a year or more? I know that's not what people want to hear. I know the narrative is that Bitcoin always comes back stronger, and historically that's been true. Every previous Bitcoin cycle has seen new all-time highs eventually, but the past doesn't guarantee the future. Market structures change, regulatory environments change, macroeconomic conditions change. And the Bitcoin of 2026 is fundamentally different from the Bitcoin of 2020 or 2017 or 2013. It's more institutionalized. It's more correlated with traditional markets. It's more sensitive to Federal Reserve policy. And that changes the dynamics. I'm not saying Bitcoin is going to zero. I'm not saying it's a worthless asset. What I'm saying is that the assumption that Bitcoin automatically recovers and makes new highs might be an assumption worth questioning. And if you're holding Bitcoin right now, if you're making investment decisions based on the certainty that it's going back to $150,000 or $200,000, you might want to at least consider what your plan is if that doesn't happen. What if Bitcoin trades between $50,000 and $80,000 for the next 2 years? What does that mean for your portfolio? What does that mean for your strategy? These are uncomfortable questions, but they're important ones. So here's where we are on February 9th, 2026. So here's my question for you, and I really want you to think about this and share your thoughts in the comments. Given everything we've discussed, given the liquidations, given the macro uncertainty, given the technical setup, where do you think Bitcoin goes from here? Are we at the bottom, or is there more downside ahead? Are you buying this dip, selling into strength, or just sitting on your hands waiting for clarity? Because the decision you make right now, in this moment of maximum uncertainty, could define your financial outcomes for the next several years. Don't let FOMO drive your decisions. Don't let fear drive your decisions. Think clearly, act deliberately, and whatever you do, make sure you can survive being wrong. Because in markets like this, being right is less important than staying in the game long enough to eventually be right. If this video gave you a different perspective on what's happening in Bitcoin right now, hit that like button. Subscribe to the Wealth Continuum if you haven't already. And share this with anyone you know who's invested in crypto, because they need to understand what's really happening beneath the surface. The mainstream media won't tell you this. The YouTube hype channels won't tell you this. But this is the reality. This is what's actually moving markets right now. And understanding it might be the difference between surviving this volatility and becoming another statistic in the liquidation data. Stay sharp out there. This market is unforgiving, and the decisions you make in the next few weeks could echo for years to come.